Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, June 19th, 2024, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow trader Viper XL 007, and we are going to have a fireside chat episode focused around compounding interest and the power therein. And while it may be slow, much like the tortoise and the hare, sometimes slow and steady comes through in the end. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you like to trade. Love to hear what type of content you're interested in. Also, you can find my equity trades, the good, the bad, and the ugly at fedigang.com/Sprocket888, link down below. Last, this episode is available in an audio-only format wherever you get your podcasts. And if you look for us and can't find us, let us know and we will get it there. But let's hop to this week's episode. Viper, before we get kind of going in the topic of compounding interest and compounding growth, I do have to share that this evening I decided to pour myself a beverage in the Blockhead Traders glass. The reason I got this out was not just because we're having a fireside chat this evening, but recently was Father's Day, and I got a very wonderful clear ice ball maker. So I had to try it out. It took several days to freeze the ice, but it is a crystal clear sphere in my glass, and I thought this was very appropriate for the fireside chat today.
I am as well. Firesiding, and it's almost out, but get a little smoky smoke for the fireside part. But the real neat part about this is not the smoked part of it. Though, let me see how that. Oh man, cherry wood, so good.
Also, I see you're sporting your Blockhead Traders glass with a not so crystal clear ice sphere.
Indeed. All right. So here's what I'm actually drinking. That's the exciting part. Mash and Mallow S'mores whiskey.
Oh my goodness.
Which is, let me move it a little bit on screen there. Yeah, a little bit of a crazy adventure down Flavortown Lane. So this is the first time I've smoked it, and that is a very, very nice touch to it.
This is going to be like the whiskey episode, but I have to ask how you like it, because I went to the store and saw a similar whiskey when I picked up. This is a pretty contemporary. It's a Willet straight rye cask strength. But the same day I bought that, I bought a Schmallow whiskey, which is like a s'more marshmallow whiskey, much like you have. And to be quite frank, I can't stand it. It's gross.
So, knowing what I know about what you like to drink, that probably holds true here as well.
Okay.
This is very sweet. To anybody else, as long as you go into it, not like this isn't like a whiskey drink. Like, it's not like you don't go into it like to appreciate whiskey. You go into it the same exact way you would go into the peanut butter whiskey, the screwball whiskey.
Okay. But I like that.
Which is, okay. What was your issue with the mallow you had? Was it too sweet, or was the flavor?
Yeah, I think it was just the flavor and the sweetness. Like, I don't know. The screwball, I'm a sucker for chocolate and peanut butter. It's probably the only sweet thing I really much care to eat. This was just kind of like a fake sugary, marshmallowy, whiskey bitey. I don't know. I just didn't like the combo.
All right, maybe I'll pull back a little bit on the. I'll reserve the right to say I told you wouldn't like it, but might pull back a little bit and say maybe if you ever saw it, you should try it. But because it's still a sweet, it has that sweetness to it. It very much has a marshmallow flavor to it, which I could totally see how that can easily be construed as like a very artificial
Yeah.
flavor. But there is also a notable hint of chocolate in this one. And I mean, smoked, like it just makes me want to be sitting by a fire in the fall. I mean, maybe you should wait. If you're ever going to try it, like at least surround yourself in the environment to give it its best shot.
I'll keep that in mind when the fall on a fire sounds good, but right now I don't know if you know, but we're having record temperatures here in Ohio. I think we got up into like 98 today or something, and this is like why I don't live anywhere in the South. But I'm like, this is why I live in the North. What's going on? Why is it like this now? It's horrible.
Yep. You get no pity from me.
Yeah, you chose to live in the swampland, but anyway, back to the topic of this episode: compounding interest. So I wanted to touch on this because I feel lately we've hit a lot of episodes. Really short-term trades. That's really what we're about. We're not really about an investing show. But crypto trades, stuff like that. And I feel, especially with our talk on GameStop for 2 episodes in a row, and some of their stuff, I felt we got a little bit tilted to the real speculative side of things. And that's not really what my core trading thing is. I'm kind of a slow and steady, regular, methodical, predictable type of trader. And I started my trading journey back in 2019 is really where I started to research and learn and input. And I really started my account with $2,500. Like it's not a joke. That's literally what I had to put in there because I wanted to make sure I had enough to do margin, which I think you needed a $2,000 for margin. And I said, well, I should probably have a little bit more than the bare minimum. So I went to 2,500. And just constantly dripping money into that at a rate, and then looking and reinvesting the returns really helped kind of, I don't know, amplify my progress as far as not, scraping money off the top and constantly keeping that lower balance in there, but let it grow. And so I wanted to focus this episode really kind of on talking about that compounding growth and where it can really get you. And the basis of where that started for me and why I started getting into the trading and investing and kind of the stock market in general is, I still have a day job, but I started to realize that there was a common theme among people that were building generational wealth, is what I've said in past episodes. And that is all of those people, not a single one of them relied solely on an income stream from a job, basically an earned income stream. And I had read different books and stuff. One of them that really highlights this concept that I do like and would recommend anybody is Rich Dad, Poor Dad. And it really talks about this kid growing up and how he had what he considered 2 dads, a rich dad and a poor dad. One was his biological father. One was another father who was his friend's father. And the whole premise of it was earned income is good, it's valuable, it's useful, but it's the worst kind of income. And it's the worst kind of income because you're limited. Your time, basically you're trading your time for money. And you have a finite amount of time. There are only 24 hours a day. You still need to sleep. You need to eat. You need to have a personal life. And so there's only so many hours that you can give to a job for work where you're going to trade that time for money. And then there's a finite amount that you can kind of get from that, right? You can keep saying, hey, give me more money, give me more money, give me more money for my time. But your skill set has to get better and better and better. And to better your skill set and whatever it is that you're doing takes other time to get better. And so, it's kind of then a self, it's a process that kind of starts eating at itself. And not to mention, and they didn't go to this too much in the book, but in other things I've read, one of the worst types of income to have from a tax perspective is that earned income. All of our tax laws, all of the things, at least in the United States, are really focused around taxing that as income. And you start getting into other areas of unearned income, interest, dividends, capital gains. that are taxed more favorably. Also, those things are not directly trading your time for money. And so that's where I started to try to say, how can I amplify my income stream? How can I get other streams of income? And how can those kind of grow on their own in a passive way? And I know what I do is not truly passive, but it's something that does scale and does amplify. And so that's really kind of where I came from. And, looking back now that I'm multiple years into it, I just see my progress and see my growth in my account where, I am now able to trade a lot of stocks where my $2,500 starting deposit was like, gee, someday I would love to be able to trade a, $150 underlying in the option market without protection, like naked. Like I love to sell a put on a $120 stock. And that's something I regularly do now around earnings. And that's because I've had this constant, steady, stable growth. I didn't get any sort of massive inheritance from anybody. This was a drip, drip, drip in my account. And just taking the profits and reinvesting them and taking the profits and reinvesting them. So before I hop into some of the interesting rules and graphics and stuff like that, Viper, how does that strike you? I mean, you tend to always bring us the more speculative trades, but is compounding growth something you've been exposed to?
Yeah, certainly. And it's so. I mean, it the power of compounding, especially compounding interest. Was something that initially hit me. I had a huge eye-opening experience way back in college. Some financial class that I don't even think it was like part of one of the classes I was registered for. I think it was one of the extracurricular things I was a part of that they had some financial guy come in and talk. And specifically in that particular case, he was talking about the power of various IRAs, Roth IRA, traditional IRA, and all that sort of thing, and talked through the power of compounding interest. And with our entire careers ahead of us as young sprites in the world, it was the emphasis was that when you start work, cutting out 2, 3, 4%, whatever you can do, into an account. Investing it in something in the market, and in a more stable investment or whatever. But the point was just how that average rate of return compounds over time, such that I forget the exact numbers. It's very dramatic, but I won't even try just in case. But basically having a small contribution, and then the way compounding interest just eventually takes that thing to crazy heights where it's like, hey, you now have $1 million in your retirement account and it only cost you, say, $50,000 or something. It promised I wasn't going to do those numbers because I didn't check those, but it's along those lines of just the power of that compounding interest. So that's something that's always been on my mind. The math obviously checks out and all that sort of thing. Fast forward to where I'm at now, like you said, still doing plenty of the speculative stuff. I need to do more of the more stable yield-bearing type of plays, but I do have a compounding strategy that I want to call out eventually when we get there. Though it is, I don't want to say questionable, but it is a little. It still has the hints of speculativeness in it than what I think you're going to talk about, but. I've been doing that as a big part of my general market approach and my general portfolio, and it is working out well to be a little bit more of the reliable income. And I'm not even using it as income, but just the more of the reliable side of growth in my overall net worth, if you will. But I'll get into that after you take us down your road here and see how they compare.
Yeah, for sure. And where I'm going to start with is, and I don't want to ever really give any numbers because I think if I numbers means the stuff that I've achieved over the course of the 4 years and stuff like that. Because I know if somebody came to me 4 years ago, 5 years ago when I first started, and they said anything that I would say now, my brain would say, "Yeah, right, whatever. You did something else." And I don't want that. I don't want that to be the message here. I really want kind of the conceptualize that this is very feasible and very doable. So if we start off, there's interesting thing that I read about that pretty much checks out. It's called the Rule of 72. And there's all kinds of fancy formulas you might see out there as far as, spreadsheets and your present value and future value and what your return is and what your investment is and your pay down of this and that. And there's all kinds of things you can do in a spreadsheet that gets real fancy. And I've done it and it's cool. It's great. Go for it. But there's also some quick and dirty calculations. And that's really where this rule of 72 comes in. And the rule of 72 simply just says, take whatever annual rate of return that you anticipate on having, divide it by, take the number 72 and divide whatever that rate is by that. And that is the number of years it will take to double the money. So an example of that is if we say, hey, let's take 6% return. So if you assumed a 6% return, you would take 72 and you would divide that by 6. So you don't do 6%, you divide it by 6. That was the first time I was messing around with this. I started putting the percentage in there. Just drop the percentage. That gives you 12. That means if you had a 6% return in 12 years, that money will double. And in another 12 years, if you kept that same rate of return, it would double again. And then it would double again. And if you see, and you do a little math there, that's going to be exponential growth because, if the first one you double from 2 to 4, okay, great. Your next doubling, which will be the same amount of time, you're going to go from 4 to 8. And then the same amount of time, you're going to go from 8 to 16. And the same amount of time, you're going to go from 16 to 32. And you can see that all of a sudden, you started at 2 and now you're at 32. And that really, really starts to kick in. So to give a little bit more idea, instead of just showing a logarithmic graphical scale, which you can get all over the internet if you just kind of Google some of it, I said, let's just take a 10-year time horizon. 10 years is not terrible, terribly long. It's something tangible. It's something in the future. This was roughly the time horizon that I started with when I started looking at how to get these supplemental incomes. And I said, look, if I want to retire in, say, 10 years, what do I got to do? What if I do something, where am I at? And so this calculation that's on the screen there at the bottom, we start at year 0. And in year 0, I say, I got $20,000. I'm going to put in this IRA account. I'm going to put in this investment account and I'm going to let it grow. So the seed money here is 20 grand. And I said, okay, what is a reasonable amount of contribution that one might consider to that, right? We have all kinds of people, hopefully all kinds of people watching this stream. And so, putting $5,000 a month, that's not very reasonable. So I said, well, the IRA contribution limit last year was $6,000 in the whole year. I said, let's just say we met that, which is it's $500 a month, which, yeah, that's a chunk of change, but to me, I don't believe that is that unreasonable for somebody that dedicates, putting some of that money aside. And kind of like you said, Viper, I think one of the secrets to this is carve out that contribution early and stick to it. So maybe you get a raise at work. Maybe try not spending that raise. Maybe say, you know what, I'm going to take that delta and I'm going to put it straight to a monthly contribution, and try to keep your cost of living constant, and don't elevate your lifestyle if your income changes. That's one way that I think it's very easy to kind of carve out this stuff. So in this example, $500 a month. And I said, well, what annual return? So this is not like a savings account. It's not a high yield savings account. This is basically an investment account, something that you're going to put money in the market. And I think if you looked at the annual S&P return rate over a long period of time, you're probably going to come in around 10, 12% annual rate of return. Not really sure. You can look it up. But I arrived at 15%. How did I arrive at 15%? Well, my investment strategy that I tried, my trading strategy, originally tried to target 10% a month of return. I've never really hit that consistently. Realistically, my results have been in the 4 to 6% a month return on my trading style. That's selling volatile premium. So if you look at that, multiply that by 12, and you can see that's quite a bit more than 15%. So I said, let's be conservative about this because I've had bad months, I've had bad years. So let's just say 15% annual return. You can modify this how you see fit. But what I want to call out is there's 3 rows. The first row is how much I put in. So that is the amount of money, the new money that I have contributed into that. And that's cumulative. So by the end of this whole thing, I have put in $80,000 of cash that didn't appreciate, right? So just call that's my cash contribution. The next row is the growth. And what that is the growth for that year alone. It is not cumulative. So when you see on year 3, $7,000 of growth, that means the interest that year yielded $7,000 that added to the bottom line. And then the last row is the total. So this is cumulative. This is the total running value of that hypothetical investment at the end of that year. So it includes all of the cumulative growth. It includes all the cumulative contributions. What is that account worth? And what I think will be very obvious to you is you see starting at 20 grand, and in 10 years' time, we have 10x that money. And that account holds $226,000. And so that really, I wanted to do the numbers because I think it was a little bit more powerful, at least for me, in seeing that in that year 10, that lump of money is generating $31,000 of income itself. I'm not doing anything other than the trading strategy that I'm implementing there, but like there's no time that I'm trading in for that, and that's itself growing itself. And I really equate this, Viper, when we were kids, I don't know if you remember, right? We'd always try to go out and we'd try to build a snowman or something like that. And depending on the snow type, it was kind of hard sometimes to get it going. The snow, it was real powdery and stuff. We kind of had to take our hands and really cram this kind of snowball together. And we kind of roll it a little bit in the yard, and maybe something stuck to it, and maybe we got bored, and I picked it up and threw it at your face. I don't remember what might have happened, but eventually we got the thing going enough that it started getting heavier and heavier. And I remember we would roll these things and to the point where we just couldn't roll them anymore. And we're like, well, I guess this is where the snowman's going because we can't get the ball any farther. And
or the igloo's getting built.
Oh yeah, that's true. That's true. There were lots of igloos that came out there as well. But I really equate this to it, and it can be very frustrating where you don't see a lot of those returns very early on. You're like, man, all I'm seeing is this, $500 a month going in. Where's the big money? Where's my big paycheck? And then just one day it starts getting bigger and heavier, and then you're like, whoa, this is pulling in how much in interest? And so I don't know, that's kind of where some of these numbers and stuff shape up for me. How's that strike you, Viper?
I mean, it's sound. I would say the one thing I want to call out for further discussion here is we're talking about this number of 15% in interest. And so I want to kind of dig it because everything makes sense to this point. Like just putting on my newbie hat, and the math looks great. The math is awesome, but 15% or even 6%. Like, how do I accomplish that? And you mentioned it in there as far as your trading strategy goes and things like that. So you're comfortable with 15% based on data you've collected on your specific trading strategy, which viewers of the show know is options based, which is slightly advanced. But is that a fair assessment as far as how you're arriving on 15%? It's not just showing up and putting money into
Yep.
something and then it's just magically generating 15%. Like you have a system in place that you're following, correct?
100%. This is not I found this magical ETF and I just put this money in this ETF and this ETF gives me 15% a year into perpetuity. No, there is definitely an active component in that. And that's where I asterisk this with, your mileage may vary, because maybe to you, you don't want to do that. You're not comfortable with that. And maybe to you, your number that goes up there is 4.5%, which is the current, treasury yield, which can be considered kind of the standard going, like the risk-free rate is what they call it, because you can go into treasuries risk-free and you can get 4%, 4.5%. And so substitute in your own strategy. I have what I call a semi-active strategy. So I call it semi-active because, yes, it does take a little bit of time to look for these trades, put them on, see them through. You have to go through drawdowns, stuff like that. It's not a set it and forget it type of thing. So I definitely don't want to give that impression. Maybe a set it and forget it doesn't yield 15%. Maybe it yields 7 or 8%.
Okay. So that kind of is enough of a slight segue, because that's certainly a part that anybody hearing this is for the first time or just exploring in that beginner stage. That can be a little bit of a sticky point, is actually realizing those rates and those returns. So, in your case, like you said, your whole option strategy and all that sort of thing. The thing I wanted to talk about was just sort of my own strategy for this particular portion of my portfolio. So, I think it's important to contextualize. Like I said, big picture. There's buckets of all sorts of different exposure. There's the super speculative exposure that we talk about with any sort of crypto plays or anything like that. There's still some equities exposure, things like that. So I want to contextualize that what I'm about to talk about is not like is not a sole portion, but there's these different segments of my portfolio and the role that they play in it. So one way that I realize this compounding strategy here in a slightly more, and I mean, nothing is financial advice here, obviously, but something to think about as far as approachability as you're learning a market or something like that. So what I do for the compounded portion of my portfolio, because I am so active on other things, I definitely wanted some sort of economic engine that I didn't really have to babysit, and I could just largely be relatively hands-off. It's on a super long time horizon. It can weather the storms, is I guess what I'm trying to say. So what I do is I've talked about it a lot. VTI, VOO, the Vanguard ETFs, the total market, the S&P ETFs, index ETFs. So you can do this with anything that you have that investment mindset on, which we've talked about before as well. I'm specifically picking VTI and VOO or any index ETF because those have a much more reliable rate of return, even in various years of volatility. Those are the epitome of, I'll be careful when I say it, but up and to the right. I mean, the chart speaks for itself in the entire history of the market on a long enough time horizon, 10, 15, 20 years, up and to the right. So I'm specifically calling out those index ETFs and focusing on those. So what I do is getting in, exactly like you said, having that allocation of capital. What I specifically do, and again, still somewhat of a work in progress as to the efficiency of the mechanics. So there's certainly ways I could optimize this, but it's getting the job done for what I need it to get done. So set aside that capital, bring that capital in. If I was just getting started, VTI or VOO, doesn't really matter which one, they trend fairly well together. I make an initial investment of a certain amount, but I want it to be not, exorbitantly huge, but I want it to be fairly sizable to kind of hold a foundation of entry. And then I set up just a daily buy. You could be daily, it could be weekly, it could be monthly, whatever you want. But I kind of DCA, dollar cost average, into that position. And in my case, I do it on a daily basis because we live in the world now of very lows, if not fee-free trades and all that sort of stuff. So, so I bring in this capital. Like if we just go back to your $2,500 example of where you started, if I brought in $2,500 of cash, maybe 600 would be that initial investment amount, and then maybe a $5 a day DCA setup on it, or something, whatever the math works out. And the goal with that is to leverage the price action of that particular index ETF, and over a long enough time span that it gets positive, and whatnot. So meanwhile, that cash is sitting there, depending on your brokerage. Some brokerages offer some yield on idle cash sitting there. I don't look for that, but that's a nice bonus if that exists. And then basically what I do is I just let that engine run of DCAing those entries every day, $5 or $6, whatever. And then periodically I'll come back and look, and I'll say, where are we at? Let's say like 2 months later, I come back and look. I'll keep an eye on the free cash, because if I don't have an external drip into the account, I have that cash that I first moved in, that's what I'm buying out of. So I'll come back 2 months later or whatever. Say, first of all, is there still cash doing the daily buys? Yes. Cool. Then next, where's the position at? And basically my own, these are some of the rules that I'm still nailing down in the strategy. But if at this point for an index, if the position is up over 10%, that's pretty aggressive. If the position's up over 10%, then I just immediately shave some of it off and I sell about 5 to 10% of the position. And that cash just goes right back into the cash bucket to do more DCA buys as time goes on. And so I'll do that periodically. If I'm over 10%, let's say it's been 6 months or something, and it's just been a crazy, cycle. The position's up 20% or something, then I might even be a little more aggressive where every day I'll come in and sell 5 to 10% of the position until that profit amount of what's remaining there drops back to that 10%. Because obviously when I sell, I'm raising my cost basis. If it's been a bad few months and I come in and it's negative, then I just don't touch it and it just keeps buying. And now I'm lowering my cost basis as it goes in and what. So that's the gist of it. And like I said, that's one portion of my portfolio. And the main function of it is just to capitalize on the long-term price action of something like an index ETF. And I just kind of, depending on high or low, peel some off, which then reloads the buying power. And then we just keep looping that around. So I think the main takeaway though is not, copying or exactly doing what I'm doing, but our strategies are wildly different in this particular case with the options versus this. And the bottom line story is both of these are a fairly rigid, methodical, I would even say mindless process of, like, especially like in my DCA, I'm not even looking at the market. I'm just looking at where is my investment. If it's negative, don't you dare sell, because if you sell anything, that's taking a loss on it. If it's positive, then let's compound some of that profit and make it available for the DCA buy in and out. So the main takeaway is the systems are rigid, which is super important in a successful compounding strategy. Because if you're not consistent, then it's going to be a lot harder to figure out when things aren't working, what needs to be tweaked. So for now, that's what I'm doing, and it's working. I haven't done super deep analysis on like numbers, and like I said, it's probably not the most efficient strategy in the world, but it's very approachable and it's absolutely mindless. Takes 30 seconds to log in, check, adjust, and move on. So that's what was most important to me.
Yeah, and to be fair, I too have a more mindless and passive strategy in my retirement account. I don't really talk about it on this show very much because we don't really focus much on the retirement aspect of things or the investment aspect of things. It's very similar to your strategy where I'm basically doing a weekly buy and I put in monthly deposits. And the money does go into very broad index like the S&P, like the VTI, like some bond ETFs, treasury ETFs. To frame some of this, I just looked up some of the history on the S&P index, right? So if you take the S&P index from its very, very beginning of time, I think it was like 1928, something like that, when it came out, and you look at the average annual return rate of the S&P, it's 9.9%. If you look at that since like 1958, which is what's considered more modern times, it's about 10.25% average annual return. Since 1958, it looks like the S&P has only had 14 down years, where most of the up years are in the range of 15 to 30% returns in those up years. And so I don't really think that 15% is that far off from a very passive rate that might be achievable in something like an index fund. It also happens to be a conservative way of looking at my trading strategy as well. But just to put that into perspective, if you just did straight up S&P since 1958, the average annualized return is 10.25%, which is not too shabby.
Yeah. Well, not at all. And I mean, one nice thing with index ETFs is it's a little bonus when you get the little dividends coming in, especially as that's growing and compounding. Then now you get dividends off of it, and those get compounded in. And it's a nice little engine. For me personally, the other thing I like about it is that rigid process of when to sell. Really helps with the market psychology, the market emotions, because every single trader that walks into this space, every single investor that walks into this space is going to struggle and probably lose money on when to sell and when, all that sort of thing. And so to have a process that just very methodically says, nope, I sell here. Nope, I sell here. I mean, it's one of the things I love about your option strategy. Is at its core, I know that sometimes it fluctuates, but at its core, it was, hey, this position's up 40%, sell it, close it, moving on.
Yeah, keep it mechanical.
And just getting into that mindset of I'm done and I'm taking this and we're moving on.
100%. I think that mechanical nature of it is very, very key. Whatever your process is, whatever your strategy is, the more mechanical it is, the more non-emotion based, the better that you are. One call out that I had mentioned, you mentioned dividends there. First of all, the rate of returns does include dividends that I quoted. What that does show you is S&P index is largely a very passive, very low fee thing. Like the fees on the SPY are incredibly low. And if you are going with some fancy fund, fancy trading group or something like that, this is why people benchmark against the S&P. Because if you can't beat the S&P with your rate of return, you're losing money because you're paying somebody not only the fees, but if they're not returning a value that's better than the S&P, you can get a better rate cheaper with lower fees to go to one of the S&P. So don't lose sight of the fees that some of these things charge, because some of these fees can be greater than 1%, and you have to take that into account and take that off of your return. Now they're constantly going lower and lower because they're always in a price battle, but that low fee really should be the number to beat. So that brings us to the end of this week's episode, really covering compound annual growth. And I say growth because, your growth could come in the form of interest, in which case you're dealing with compound interest growth. It might be a passive trading style, such as Viper laid out, where he's dollar cost averaging into massive index funds that are basically tracking entire, the whole stock market in the case of VTI. Or maybe it's as more narrow like a S&P index, or maybe it's a NASDAQ or something like that. But, maybe that's your focus. Maybe your focus is premium selling like myself. But either way, it's taking those gains, that growth, and compounding on it, putting that growth back into the machine, and making sure that your trading strategy, your trading vehicle is very mechanical, like a machine. Take the emotion out of it. Emotions will do nothing but wreck you in the long term. It might feel good to trade on emotions. It could feel really bad to lose on emotions. But the more that you take the emotions out of it, the more mechanical you get, the more repeatable you can become, and the more you can tune your strategy, because you're going to look at it very objectively and very fact-based. And you're not going to make I really like that company. The management was so good. I don't know why it went down, right? You keep everything mechanical, and all that emotion comes out, and it lets you help make clearer decisions. So don't ever underestimate the power of that compounding growth. There's so much there, and that really can help build that generational wealth. And that's really what I set out to do. That's what I think everybody can achieve with this. You have to be disciplined in constantly reinvesting that growth. You have to be disciplined about the money that you've carved out to contribute to that, to feed the machine. But it really is something that is achievable and is very reasonable for everybody to attain, in my personal opinion. So good luck out there as you kind of explore this on your own. Lots of internet research out there, lots of internet-based stuff. You can not take our word for it. Go get the information yourself. Good luck, have fun, and remember, think outside the block.